If you can't find a stock to buy right now, you think everything's overvalued, I hate to break it to you, you suck at finding stocks to buy. If a company's growing at over 20% per year, with earnings increasing more than that, that deserves a multiple of about 30 to 35. That is like cheap for that kind of stock. If you don't like growth stocks, that's fine. There's so many small caps, especially micro caps, trading at under 10 times free cash flow. I'm buying ones that are under 5 times free cash flow. There are companies out there trading at less than the value of their balance sheet. Not by a little bit, by a lot. So if you can't buy anything, don't stop indexing them. That's probably your place, unless you want to invest in understanding how to read financial statements. You must learn how to read a balance sheet. You must learn how to read a cash flow statement. And then you must understand with what growth rate does that become very cheap and when? When does Palantir become cheap? At what, 100 times sales? I don't think anytime soon, but everyone knows that ticker. You got to find tickers that most people don't know about or basically just index. Mega caps. Do I like Google? Yes. Do I like Broadcom? Yes. But everyone knows those tickers. If those tickers, the TPU wave does well, I have other names that are going to 3x, 4x, and they're going to act a lot like Coherent Corporation. And I'm buying stuff that objectively is overvalued, okay? I bought App today. I bought App Lovin', call option on it, and it's tripled so far today. I don't care what the price is when I'm trading. And then, if I make trading gains, I can put it into well-valued businesses as an investor. Understand the market that we're in. Everyone's talking about bubble this, bubble that. Okay, guys, depreciation doesn't matter. Whatever Michael Burry says, forget it. A bubble is 4 to 5 times divorced, meaning 4 to 5 times higher than what the fundamentals justify. Do you think NVIDIA, which is likely going to be under a 25 forward PE next year, because they always beat, do you think that is a bubble, 25 PE, for a stock that is growing over 50% per year? Like, come on, I get it. We have quantum. We have some irrational things in the market. That's always the case. Have you guys been around? Seriously, there's always pockets of the market that are extremely overvalued. In 2018, it was cannabis. In COVID, it was SPACs. Then it's quantum this year. It always happens in a bull market. That doesn't mean we're in a bubble and you can't find anything to invest in. And one more thing. People say, oh, this is all pumped up by money supply growth. Like, what? Yeah, that means when you're being conservative with your cash and the government's printing 10%, 8 to 10% per year in the money supply, you're losing. Like, you think you're not taking risk and you're just being safe because it's all propped up by money supply, but you're literally the person that hurts. Okay? Learn that. Learn that. That's the world we're in. If they stop printing money, you know what? I'm going to go back to probably equities that have hard assets attached to them. But that's not the world we're in. Do you think Hassett coming in is going to stop the money printing? Do you think the Democrats are going to win in the midterms and all of a sudden stop the money printing? Do you really I know that sounds ridiculous. So what I need you to do is understand the mode we're in. Do one of two things. DCA and chill, or learn a little bit. Think objectively without bias that's political, or you see more people making money than you. And this is what a lot of bears do. They say, it's a bubble, it's overvalued, it's going to crash, because they don't have money in the market. Because they don't have money to put in the market. So they just want to be a perma bear, right? And they see other people getting rich and they're like, well, that's going to end. Unbias yourself. Think about objectively what the best decision is to make. And then, as a risk management idea, okay, do not have all of your money in AI on margin. That's just one. Two, then you're going to see a parabola break when this thing actually breaks. It's not going to look like the DeepSeek stuff. It's not going to look like, the past month and a half. There's going to be volatility and you have to stay in the seat. I said this a month ago. When this thing goes parabolic, and it's going to continue going parabolic because that just tends to be how it goes, because people start shorting it because it looks parabolic, and then it becomes more parabolic and people start shorting again. And when they're all dead, then the parabola may break. It probably will. And then when the parabola breaks, and you're going to know it, it's going to go from being up, the whole market's going to be up 3% one day at the, like in the morning or at the open, and it's going to close down 2%. Then you may take risk off the board. But what I'm telling you is, if you wait 1, 2, 3 years for this AI train to reach the 9th inning, and you make no money all of that time, the value of your money in terms of the share of wealth in the world, I'm not talking about CPI, is going to go down by 50%. So you're guaranteeing yourself a bear market in terms of your wealth, straight up. If you can make some money on the way down and protect your gains, you're going to be in a far better position. I urge you to stay off the sideline. Passive investing is fine. If you want to be an investor in this age, you can't be like trying to be the smartest guy in the room like Burry has always tried to be since he had one big win. Just understand the big trends, have a little bit more kahunas than the average person. Don't take extreme, it's called in Kelly Criterion, unaliving risk, self-unaliving risk. If you go way too far in the risk spectrum, you're going to blow your account, because it just takes a little bit of a drawdown, and then you're going to blow up your account and have nothing, and the market's going to take off without you. Don't do that. But have an understanding of the position that we're in going to 2026, when we have the big, beautiful bill. That means you can amortize R&D for all of this AI, as well as manufacturing in year one. All of the manufacturing spend, industrial spend, is going to kick off. So that means that other stocks than tech stocks are going to do well. Okay? Everything but software might do well. Software is going to be winners and losers. Understand the position we're in, because it's really exciting if you think about it. For somebody who's been in the market since 2007, straight up, I was trying to buy stocks in 2005. My parents wouldn't let me. I got to see the most disastrous thing in most people's lifetimes, which is the global financial crisis, and be like, Ford's at $1, but I like Ford cars. Buy Ford for $1, sell it at 12 a year later. I've been waiting for a bubble, and I'm so excited that we might get one freaking good one in my lifetime, because .com, I'm 5 years old, it doesn't matter. We may get it, guys. We may actually get it. So position yourself in order to capture that. Are we in the early innings of a bubble? Well, I don't know. It kind of depends. It depends on what happens next. If we are, a lot of money will be made, and sure, a lot of money will be lost. But it is better to be in the game than outside the game from this third inning out of 9 in the AI trade.